managements. First off, we have Mr. Yatharth Tyagi, Director at Yatharth Group of Hospitals, to talk to us about everything that's playing out in the hospital space as well as Yatharth in particular. Mr. Tyagi, let me first start off with how and what kind of trends are playing out and where would you look for in terms of scaling up with regard to your top line for FY25, given that you have a hospital or two with lower utilizations. Hopefully those scale up and ramp up. So what's the kind of expectation for FY25 full year?
See, I think for next 3 to 5 years, we feel the company is on a good growth trajectory. We do expect, the growth of around 30% yearly for next 3 to 5 years is concerned, as far as top line is concerned. You did mention 2 of the hospitals are, still new. So the acquisition that we did of Jhansi Orcha Hospital as well as Faridabad Hospital. So specifically, if I talk about Faridabad Hospital, because that's a, good RPOP that we have seen in the first quarter of its operation. It just operationalized last quarter. So this hospital is, expected to ramp up occupancy is concerned, not just in this 1 year, but across the next 15 to 18 months. We do expect this hospital to become break even, and as well as the occupancy ramp up is concerned in both our hospitals of Greater Noida and Noida Extension is concerned. This should be giving the good growth as far as the next few years is concerned. Another key factor that we are hoping and we are quite sure about in the next few years is the growth in our average revenue per occupied bed. So RPOP is expected to grow. I think we do expect, we have seen a growth of 10% last year in terms of RPOP is concerned, and we do expect a similar growth in the coming years ahead also.
Right, Mr. Tyagi, you're also targeting in an expansion of bed capacity to 2,800 to 3,000 by FY28 is what you've guided. You're also doing greenfield expansions as well as brownfield expansions. Now I want to understand that your cash position right now is roughly 182 crores. So how are you planning to do all of these expansions plus the kind of brownfield expansions that you have?
So the expansion, the bed capacity that we are going to be doubling in next 3 years is going to be fueled by 3 ways. First is, as you mentioned, there is a strong cash position already in the books. We have around 180 crores. Plus, we will be generating good internal accruals now that the finance cost has almost become reduced significantly since the IPO. At the time of listing around 30 months back, we had a bank debt of around 250 crores. Post IPO, we became completely debt free, and today there's just a small debt of 80 crore that we have taken for the Faridabad Hospital acquisition. So the finance cost has significantly reduced. The network is increasing, so internal accruals will also be able to generate enough cash going forward. And third way is, again, there's always a room for more debt that we can still take. If we were able to service a debt of 250 crores around 13 months back, the network growing today, if required, there's option can also be considered in next 3 to 4 years. So as far as doubling a bed capacity is concerned, we do not require any external funding for these acquisitions.
Also, Mr. Tyagi, Varsha here. So I was just seeing that you are actually increasing your share when it comes to super specialties, and you have also introduced your oncology and robotics segment. So I just wanted to understand, so currently, if I'm not wrong, oncology is contributing 10% to your revenues. Now, where you want to take this, because that will help your, that will aid your margins and your RPOP.
Yes, that's definitely right. I think we do feel oncology to be a big contributor in our growth for next 3 to 5 years. See, we were doing medical and surgical oncology since few years now, but radiation oncology is something that we've recently started. We have installed LINAC machine. Now we're doing PET scan. We're doing brachytherapy. So I think oncology, which was just 3% a year ago, is today 10%. And if I talk about specifically Noida Extension Hospital, where the complete oncology setup is there, their oncology is contributing to around 17%. So I think overall we do feel in this hospital specifically oncology can even touch 25% in a 15 months to 18 months of time. And as far as the overall group is concerned, we do expect oncology contribution to double in terms of percentage in the years ahead. And this will ultimately help boost our RPOP and not just oncology, but even high-end procedures like the transplant program, the liver, kidney, as well as bone marrow transplants will also be increased in volumes, which will ultimately help us to drive a better RPOP as we move forward with them.
Then Mr. Mr. Tyagi, where your margins will go, because you have around 25% of margin that you are operating into, and considering the operational losses in your Faridabad unit, and you are also entering into, I mean, you are increasing your share when it comes to oncology and super specialty, where you want to take your margins, say, in next 3 years?
See, I think we already are, delivering quite healthy margins of around 26% of EBITDA. We sort of expect the margins to be sustainable. We do expect this margin of 26% to be sustainable for at least 3 to 4 years. The reason being that, yes, there is new hospitals like Faridabad and for other new acquisitions that we will be doing each year, which will be dragging down margins a bit. But because there's a lot of occupancy ramp up that is yet to happen in a Greater Noida hospital, which is around 67% of occupancy, and Noida Extension Hospital, which is around 61% of occupancy. So in these two specific hospitals, the EBITDA margins should increase a few basis points. So that would compensate for the drag down of the margins of the newer hospital. So overall, at the group level, we do expect our EBITDA margins to be quite sustainable of around 26%.
Understood. Mr. Tyagi, wanting to understand how top line really shapes up for you, because you're suggesting margins will largely be, will not go up in a significant fashion, but your top line will, given the kind of ramp up that you're doing. Just talk to us about that, because one, oncology will obviously contribute to top line and margin accretion as well overall. But how does top line shape up currently? Maybe FY26 in the near term, or maybe by FY30? What's the plan like?
See, I think in last 1 year, quarter on quarter, we have delivered highest growth in the top line year-on-year changes as far as the complete, whole hospital industry is concerned. We have shown the leading growth in that. This quarter itself, in Q1, we grew around 37% year-on-year. So I think for next, 3 to 4 years, we do expect growth of around 30% yearly. I think if we're able to do it, that should be compromising largely from the change in the case mix, leading to higher ARPOB, and again, occupancy ramp up. At a group level, we do expect occupancy to reach around 75% in 2.5 years time. This will be the driver for the top line is concerned. And again, in 2-3 years, when we reach optimized utilization of occupancy, we will still have new beds that are coming up after these years in our brownfield expansion is concerned. So that's why we do expect this journey to continue for next 4 to 5 years easily.
Understood. And how much of that will be ARPOB and how much of that will come from fresh capacity addition?
I think it will be a fair mix of both. Yes, there is a huge room for our ARPOB is concerned, but as I mentioned, if we are yearly able to grow around 30% or around 10% of ARPOB, I think that would be a fair judgment. And as far as overall growth is concerned, I think 30% should be there. So I think around 10% from ARPOB and around 20% from occupancy should be a fair idea for the next few years.
All right, Mr. Tyagi, your ratio from government business is coming down, I want to understand that what are the kind of trends you're observing here by the end of FY25, where will the share be at? And this, I believe, improves your ARPOB overall. So how does this impact the overall business then?
We are definitely seeing more growth in our self-pay, that is the cash segment, as well as the private insurance is concerned. So automatically, once these two segments increases, the share of government business will come down. Also including international patients here, which ultimately, becomes part of the self-pay because, international business is increasing and is expected to increase in our group significantly over the course of few years. Reason being because the opening of Asia's largest international airport, the Jewar Airport, that is going to happen, in Greater Noida, which is just around 20-25 minutes away from our Greater Noida hospital, should be contributing to good number of international patient volumes. We're already, catering to patients across the world. We are doing, a lot of patients from CISF countries, from Gulf countries, as well as African countries. So international patient share increasing and private insurance penetration as, increases with time. The government business is bound to reduce, and we're already seeing it in the existing quarter. So we feel that in 3 years' time, government business should be somewhere around 25% in our overall revenue pie of the payer mix is concerned for the whole company.
All right. So international patient revenue right now is in single digits. So where do you expect this to go from a longer term perspective, let's say by end of FY26?
I think in 2 to 3 years time, we are targeting around, close to 15%, 10 to 15% of international business to be contributed. And this is, key driver also because of certain new treatments that we have started. Earlier the treatments we were offering, not many international patients come for those treatments. International patients comes for niche services like oncology, transplant program, high-end cardiac and neurosurgery. So because we have started these treatments over the course of last few years, is now we are expected to see increase in international patients from these. And again, a lot of certain key and reputed doctors from NCR are now joining us. So with them they will also drive certain volumes of international patients, because these doctors are a known name in international markets. So that's why we do expect around 10 to 15% contribution of international business in few years time.
Mr. Tyagi, any inorganic opportunity that you're eyeing on? Because for FY25, if you do a rough calculation, you'll be with 200 to 250 crores of cash flow from operation that you'll be generating.
Yeah, so I think this year and the plan for next few years also, each year we are eyeing one inorganic acquisition. So, this remaining year, financial year, we are quite hopeful to close one more, acquisition. We are in talks with a few hospitals in advanced stages. So, we are looking in territories around Delhi NCR market, big cities in UP. As well as nearby capital cities of nearby states. So we do expect one more inorganic acquisition to be added as far as this remaining financial year is concerned.
How much will that be?
So I think that should be within this financial year is concerned.
But how large will it be, Mr. Tyagi?
Yeah, so I think the hospitals that we have identified are at least 250 bed above 300 to 400 bed. There's a hospital that we are eyeing which is around 400 bed. It's available in the Delhi NCR territory. There's a hospital of around 300 beds that we are eyeing, which is in the capital city of a nearby state. So any expansion that we are doing in terms of inorganic, it has to be at least 250 bedded above. Ideally 300 to 400 bed is what we are looking for.
Understood. And Mr. Tyagi, not sure if you had a chance to check up on this. We spoke with Yashish Daya of PV Fintech, and they were suggesting a new venture which they are investing in, which is likely to do hospitals and healthcare. And this is to reduce costs for hospitalizations, especially for insured patients. So, a couple of questions here. One, do you believe that this will be a serious competition of sorts to the current hospital chains that we have? Secondly, do you believe that it will impact your overall sector as a whole and ARPOB in general?
See, I think overall in India, hospital sector is growing at a very fast pace. So is the private insurance penetration. There's still a lot of room for expansion of, not just bed capacity is concerned, but even, penetration of private insurance is concerned. Urbanization in India, in North India, across India is happening at a very fast at a very fast pace. And it's not that healthcare is not affordable in India. There are, options available for, patients across India. If they want to choose an affordable healthcare, if they want free treatment, they can go to government hospitals. If they want, treatments that are being done on, let's say robotic surgeries by surgeons who are, experienced with world-class equipments, those treatments are also available under private insurances at a good rates. So I don't see that much of a challenge with this being there. And yes, I think regulating prices in healthcare is not a straight and simple thing to implement. It does require an overall holistic approach where it is not just the private hospitals and insurance prices that has to be looked into. It comprises of a whole ecosystem which comprises of pharma drugs, diagnostic price, as well as costing of medical equipments. So any changes in the regime to cut costs or price cutting will have to be involved all these sectors. So
right.
So I think yes, I think the healthcare is massively growing, and there is still affordable healthcare available for the patients of India.
Got it. Well, Mr. Tyagi, thank you so much for giving those answers so comprehensively, and thank you so much for taking out time and speaking with us at NDTV Profit.